Well, we'll get started then. So I'm just recording this on Screencast-O-Matic because WebEx is letting me record, which is no big deal. But as I promised, I like to record these for those who can't make it live and all that good stuff. So the way I like to do these is to really just work problems with you. And so what I have open in the background, let me get to the right tabs here. I just have the our ebook open, and what I like to do with everybody is I just have problems from the back of the chapter. So if you don't recall how to get into the ebook, I kind of showed you with an intro video, but when you get into MindTap initially, then I have everything organized by chapter, and then there's a little link within each chapter of your ebook for that chapter. And it's really easy to jump around the chapter too. So if you just go to chapter contents, that's all I'm really doing, just going to jumping around and showing you guys a few things. Like at the back of every chapter is a really nice summary here. It kind of summarizes what the key concepts were for the chapter. So it's always good to look at those. I think that'll help you kind of summarize the bigger topics. I'm going to go down to the questions right here. And I don't usually go over these with you guys. You can definitely do those on your own. I give you the answers for those. So back in my.usf, and if you go into the main page and you go into handouts, the answers are there for those. And I mentioned that in the intro video. So a good way to review is to look at these questions and then kind of just think through what the answer is, or jot down what you think the answer is, or just read the question and read the answer, whatever works for you. But I think it's just good to review those. If you feel like you understand these questions, you're ready for a chunk of the homework for sure. So just always do those on your own, and then we'll go down to look at the problems. So, and the self-test problems that are here. What's nice about these, it's just a little assignment that you can work on your own if you want to, and it gives you the answer right here. So you might find that interesting, you might not, but if you want to take a look at those, you certainly can. And then what I'm going to go over with you guys, and this is how I'll do most of these WebEx meetings, is just work on the problems, some problems with you together. So I just went to the problems from the back of the chapter, and I just will go through several with you. Oh, can anybody see my screen? Can anybody see my screen?
No, we just see a gray
screen. Oh,
screen.
you do? Oh, shoot. Okay. Oh, golly. Let's try this. It looked like it was sharing.
Yes, you can see it now.
Okay, can you guys see it now? Okay, this works? Everybody see my screen?
Yes.
Okay, sorry about that.
Yes.
How about now? Do you see the Excel file open that I have? Do you guys see this?
No.
No. Well, darn. Okay, well, this is going to be fun. WebEx is different. I haven't used it for since last spring, and it's different all of a sudden. So that's my bad. Let's see. Share my meeting window. Web browser. Meeting window. How about, what do you guys see now? Do you guys see anything now?
See just a thing.
Yeah. Okay.
And now it says share content.
Okay. Let me try something else. Okay, what do you see now?
Oh, there it is. Excel.
You see Excel now?
Excel.
So I don't know if I can jump between. Okay, what do you see now? Do you still see Excel, or do you see what's that?
Gray screen.
Gray screen. Well, darn. But now you see Excel? Oh, fun. This is going to be great.
Still a gray screen.
Okay, still a gray screen. Okay, let me go to web browser. Now, do you see the ebook right here? Do you guys see like some problems from the ebook?
Now we just see the SH on the screen.
Okay. Well, golly, let me try. Let's see. Do you see it now? Do you see the ebook now?
We see the ebook yet.
Okay. What do you see right now?
Gray screen.
Wow, that's crazy. How about now? Do you see the ebook?
Ebook.
Okay. Used to be, it would just share my entire desktop no matter what I had on my screen. You guys could see it. But it's like I have to intentionally go between certain things to show you. Hold on a second here. Okay, I've got an idea. It'll just take me a second. Okay. I'm going to just copy and paste the ebook into Excel. How's that? Let's see if that works for me. Okay, I think I can make this work. Sorry about this. So let me go back to my share, and we're going to share Excel. Okay, do you guys see like an Excel spreadsheet now?
Yes.
Okay. Oh, fun. Okay, well, all I did, I just copied and pasted the ebook info into an Excel spreadsheet, which isn't ideal, but it is what it is. It's what we've got to work with, so that's what we'll do. Okay, so but anyway, if what I was doing that you guys couldn't see is I was just in the ebook and I was just showing you towards the back of the chapter. It was just a really good summary that's there of the big highlights for the chapter, and then there's also the questions that are kind of more like self-reflective questions, and I was just showing you guys those. And then these are just the problems from the back of the chapter is what these are on the screen right here. And I'm going to go over quite a few of them with you. So I just wanted you guys to see those. But WebEx has changed since I used it. I think the last time I used it was like April or May, and it's different now. So I did not know that. So that was on me for not knowing that. And so what I'd like to do is just work problems with you guys. And I gave you chapters 1 and 2 to work on this week. But chapter 1 is just concepts. There are no actual problems from chapter 1. So I was just going to really focus on chapter 2. So in the chapter 2 problems in the back of the chapter, so if you happen to have your ebook open on another screen or even your phone, like if you guys don't have the Cengage app, download the Cengage app for your smartphone, and then you can actually look at your ebook on that. Really easy. It's actually really nice. So download the Cengage app, find it, log into it, and all of your Cengage books will be there. So, and this one obviously. So what I've got from the back of the chapter, if you guys can see some of this problem, we'll see here. I'm going to just go ahead and insert a row so we can see this better. Let me just drop this right here. So I'll do some Excel magic here. Okay, so if you recall what this chapter was about, it's called Financial Statements, Cash Flow, and Taxes. And so it asks you a lot of questions kind of based on understanding a few things about those topics. And if you haven't really reviewed those yet, some of the stuff that you see here might you're kind of going to go, well, I don't know if that makes sense yet. But as I work the problems with you, I think it'll become to make sense. But one big takeaway I want everybody to kind of just be aware of is that we're going to look at this class from the corporate perspective, so it's going to be finance from a corporation. And then back in December of 2017, a new tax law was signed into law, and it went into effect for the first time for the fiscal year of, the full year of 2018. And now here we are in 2019, and this is the second year of it. So I just wanted you guys to kind of see and just kind of know that for the corporations, the federal tax rate, it used to kind of be progressive like it is for individuals. Like the way the tax rate works on individuals, the more you make, the higher the tax bracket you're in. And corporations used to be that way. And now corporations pay a flat tax of 21%. The reason the book will use 25% quite often is a lot of states have their own separate corporate income taxes, and 25 is just kind of a nice round number. So the federal corporate tax rate is now 21, and then a lot of states have some kind of a corporate tax rate. South Dakota happens to be one of the very few states that does not. So if you were a corporation based in South Dakota, you would just pay the 21%, and that would be it. So I just wanted you guys to kind of be aware of that and know that. Okay, so from there, some of the questions that we're going to look at here deal with bonds. And it says here, an investor recently purchased a corporate bond that yields 7.68%. The investor is in the 25% federal plus state tax bracket. What is the bond's after-tax yield to the investor? And the answer is actually there because I did a copy paste from the ebook. In the ebook, the answer is hidden. It just didn't hide it when I copied it over. So the answer is there. The question is, how did I get there? Okay, and so I'm going to type in a little formula here for us to look at. And we call this after-tax yield. AT is for after-tax. And yield is a return. Whenever you see the word yield, just think that's an interest rate return. And we're going to multiply that by the pre-tax yield. And we'll multiply that by 1 minus t. Okay, where t is the tax rate. So when you see t, just think that's the tax rate. And so they told us what the yield is. So the question is, what will be the yield after tax? So essentially, it's the pre-tax yield, the 0.0768, and I'm going to multiply that by the 1 minus t, and t being 0.25. And let me give this a few more decimal points so it's easier to follow. So I'm just going to multiply the two by each other. And that's my answer. So my answer will be, let me get this larger here. Okay, the 576. I'll convert that to be a percent so it makes more sense. So the answer is 5.76. Okay, so it's just taking the pre-tax yield, multiplying it by the tax paid, and so the after-tax yield is 5.76. In finance, we look at everything after tax. In finance, we kind of focus on cash, and then we have to focus on the after-tax cash flow. So the after-tax yield is what we would use to make a decision if we should buy this bond or not, if it's the right investment, and so on. Okay, so that was question 1. Question 2 is the next one. It's just right here, and the answer is already given to you. I'm going to insert a couple of rows here, give us some room. So next time we do this, next week, I'll be better prepared for WebEx not doing what I wanted to do as easily here. So I'll be better next time. So the question here is, corporate bonds issued by Johnson Corporation yield 8%. Municipal bonds of equal risk yield 5.5%. At what personal tax rate would an investor be indifferent between these two bonds? And then here's the point that you may not know yet, is that if you own municipal bonds, they're tax-free. Okay, so if I were to personally buy municipal bonds, any interest income that I receive is 100% tax-free. So what's a municipal bond? Well, it's a bond issued by a government. It could be a city, school district, county, state, and usually think about what municipal bonds are used for. They're usually used for infrastructure or things that benefit the public, benefits citizens. An example in Sioux Falls is a new high school is getting built right now, a new middle school is getting built right now, and I think it was roughly a year ago when there was a vote and basically saying to the citizens of Sioux Falls, do you want to authorize the school district to issue new bonds so that these bonds could go to paying for a high school and a middle school? And the answer was yes. And so the school district issued bonds, which will then pay for those buildings, and then they're paid back by our taxes, obviously, right? So the school district charges property tax in South Dakota. That's how they get their money, and then they'll use those property taxes to pay back these bonds over time. So the reason that they're tax-free is a couple of reasons. Well, quite often tax dollars are used to repay these bonds, and we want people to buy these because they benefit the public. So let's give people an incentive to buy them, which is it's tax-free. So most people who buy these are high wealth individuals, usually people in the highest tax bracket. They buy these types of bonds, or corporations invest in them, and so on. So, but the point is that they're tax-free, and that's kind of the whole point of the question. So another little formula for us to look at, and I'm going to call this equivalent. I'm just going to abbreviate here. So equivalent pre-tax yield and I'm going to call this on taxable bonds. And this equals, I'm going to put this at the top part here, this equals the yield on a municipal bond. I'll just call it a muni. And then we divide that by 1 minus t. So we just take 1 minus t. So kind of just think the equivalent pre-tax yield on taxable bonds equals the yield on a municipal bond divided by 1 minus t. Okay. So all we have to do then is go, well, we've got the 5.5%, so I'm just going to go 0.055, and let me get this to be 4 decimals. And I divide that by my famous 1 minus t. Okay, so there's my 0.75. And on the left-hand side, my equivalent yield is 8%. So I should move this over a bit, give myself some room. So what I'm kind of saying is 0.08 equals, at what point does 0.08 equal 0.055, the municipal rate, divided by 1 minus the t? And so let's just kind of solve for that, and we can figure it out. So basically, what's the tax rate that would be the equivalent? So we'll go ahead and solve for that. And the way this works out, if you do the math, we get 0.08, and then I'm just going to take this 0.055 and divide it by the 0.075, so you can see that math there. And what I have to do is simplify this. And so, oh, I'm sorry, I'm not doing this quite right. My bad. Is 0.055, and they take. Oh no, I'm doing it right. So we get this 0.07. So what I have to do then is basically I have to I'm trying to solve for the tax rate. So I should, instead of saying 1 minus t, I should say t minus this number here. Let me get this right. I can't do this quite right. So it's t minus 0.25, and I know this isn't quite right. I don't want that equal sign there. That's what I got wrong. There we go. So let me do this better here. So here's what I want to solve for. I want to solve for 0.08 equals 0.055 divided by t minus 0.25. And so what I have to do is simplify this and get it down to kind of the next step. So the next step for this, I'm just going to do this as a value so it's easier to say. Well, I can take my 0.08, and then I have to subtract from that 0.08t, and that equals 0.055. Okay, and then the next simplification of that is I take the minus 0.08t, and then that equals minus 0.025 as I subtract the 0.08 out. And that gets me down to, I do a little bit of division next, and then once I divide this out, I get t equals 0.3125, which is 31.25%, which is the answer right here. Okay, so it's just a little bit of algebra, unfortunately, which is not everybody's forte necessarily, but basically is trying to identify what's the tax rate where I'm indifferent. So if I'm at my personal return, if my tax rate's 31.25%, either one of these bonds is okay with me. I'm indifferent between the two, and that's what I'm trying to figure out. Okay, the next one is question 3, and this is an art gallery. And with this one, it says Holly's Art Galleries, and let me do it like this so you can kind of see the whole thing. And Harley's Art Gallery, you can see it here, reported $7.9 million of net income. Its EBIT was 13, and the federal tax rate is 21. And they're telling us, just don't worry about at this point what the state tax is. Let's go with 21%. And then what's the interest expense? And the way to do this is to write out the headings of an income statement, solve for the known values, and then we're going to take the net income number and divide that by tax to get to the pre-tax number, which allows us to solve for this. Okay, and so $7.9 million tax, in EBIT, which is earnings before interest and tax, is 13, and a $21 million tax rate. Those are kind of the key things to look at. So I'm going to insert some rows here, because otherwise we're not going to be able to solve for this. So let me do an insert here quick. And so I'm going to build just a little mini income statement. So we're going to start out with EBIT, which is earnings before interest and tax. So just think all of my revenues minus all my expenses equals 13 million. Okay, so just think all my revenue, all my expense, and I've got EBIT of 13 million. And then I'm trying to figure out what is my interest. So I'm going to do subtract for interest. And let me make this be more of a value here. Okay, so I'm going to back out my interest, and that gets me to what we call EBT, earnings before tax. And then I subtract tax, and I get net income. Okay. Well, they gave me net income. They said net income is $7,900,000. Okay, and they also told me that my tax rate is 21%. So what I can do is I can take this number here, the 7.9 million, and I can divide that by 1 minus tax, 1 minus the 0.21. Okay, and then we're going to get $10 million. So just to show you what I did, I took the net income number, I divided it by 1 minus tax. Okay, well, now I can figure this out, right? I can kind of do some mental math and go, well, if my EBIT's 13, and whoops, I'm sorry, this number goes right here. That's my bad. It goes right here. My EBT is 10 million. I can do the math now and figure out the differences, right? So interest expense obviously has to be 13 or 3 million. Okay, so 13 minus 3 million, we enter that as a negative, gets down to 10 million. Then my tax is just simply 10 million times 0.21, and we'll do this as a negative also. Okay, and so you can kind of just see the math works. 10 million minus 2.1 million is 7.9 million. So the key, though, was just this little formula right here. The net income divided by 1 minus T gives me my pre-tax income. And then my pre-tax income, my EBT, and minus my EBIT is the $3 million worth of interest. Okay, so that's just kind of a little mini income statement, but they did not show us revenues and expenses. Okay, the next question is kind of like that one. This one says, question 2.4. Let me make this larger here so you can see it. So it says Nicholas Health System has an EBITDA. So if you don't know what that is, it's earnings before interest, tax, depreciation, and amortization. So earnings before interest, tax, depreciation, amortization of 25 million, net income of 15.8 million, and it had 2 million of interest expense. The federal tax rate's 21. Solve for depreciation and amortization. So we're kind of doing the same thing. It's just the solve for is a little bit different now. So again, we can kind of start with the same format that I built before. So let me insert some rows here. And just to save myself some effort, I'm just going to copy and paste this to start, and then we'll make changes as need be. So one thing to keep in mind is that your EBITDA is kind of the first line here. And so EBITDA, and then we subtract from that, we go minus depreciation and amortization. So the EBITDA they gave me was 25 million. Okay, and then from there I need to kind of work my way down and solve for this. And they gave me some clues here, right? They told me that net income is 15.8, so I know the bottom line is 15.8 million. Oops, short of zero here. Okay, and I know my tax rate's 21%, so I can do the same kind of math I did before, and I can solve for my EBT. So I can take the net income, divide that by 1 minus T, T being the 0.21, and that gets me to my EBT number. Okay, so that means my tax is the difference between the two, right? So we can just basically just know that tax is the difference between those two. So I can take the 15.8, let me do this right here. So I can do minus the 20, and I can do plus the 15.8, and I get $4.2 million. So that's my tax. Okay, and then from here, they gave me the interest number. They said we paid $2 million of interest expense. So I'll go minus 2. Okay, so then my EBIT has to be the sum of these two. It has to be 20, and then I add back the 2. It has to be 22, because 22 minus 2 is 20. And now I know this number because it's the difference between the two. So I basically just know I can take minus 25 plus 22, and I get negative 3. So now this works. So it's just kind of a matter of putting in the top number, the bottom number, and then working my way up, just based on what they gave me. So you'll have a few problems that'll kind of work like that when you do your homework this week. The next question is 2-5, and this is Kendall Corners, Inc. They had net income of $3.1 million. They had depreciation of $500,000. Then the question is, what is net cash flow? And they're saying assume that they had no amortization expense. Okay, so the key thing to kind of remember from accounting classes is that depreciation and amortization are non-cash expenses. Okay, and so in finance we really focus on cash. Okay, so if I've got net income of $3.1 million and I have depreciation of $500,000, that means my $3.1 million has been reduced by $500,000. But if I'm focusing on cash flow, all I have to do is add it back. Okay, so the answer is really simple. It's just simply the $3.1 million plus the $500,000. So the true formula, I'm going to put that on your screen so you can see it. So NCF, which is net cash flow, that equals net income plus depreciation plus amortization. Okay, that's the formula for cash flow. And so the numbers that we have are the $3.1 million, and we have the $500,000. And there is no amortization. They said that's 0. So the answer is pretty simple. It's just $3.6 million, which probably is this number right here. Yep, right there. Okay, so hopefully everybody understood that one. That was a pretty easy one. The next one is the statement of retained earnings. And this one requires that you kind of remember a little bit about accounting again. And we have to kind of remember what makes retained earnings go up. So remember, for a corporation, you have what they call retained earnings. And that's exactly what that means. Think about what the words retained and earnings mean together, right? So it's the net income that I keep. Okay, if I'm a corporation and I have retained earnings, what I'm saying is that's all of my accumulated net income over the history of my company that I have kept for myself. And obviously you keep that retained earnings for future investment and growth opportunities. Okay, but most companies, especially if they cash flow well, will also pay out a dividend. And so the question they're giving us here, it says here in its most recent financials, Del Castillo Company had $70 million of net income, $900 million of retained earnings. The previous year retained earnings were $855. So what you have to remember is net income makes retained earnings go up. And it says how much in dividends did the firm pay? Well, we have to back out dividends, right? So you have retained earnings. It goes up for net income. It goes down for dividends paid. Okay, if you can remember that, life is good. That'll help you a lot with a few of the problems that you'll have this week. Okay.
Can you repeat that, please?
Yes, I will. So if you want to write this down, net income makes retained earnings go up. Dividends makes retained earnings go down. Okay, everybody get that? Jot that down in your notes somewhere. If that's something that sounds new to you, or your accounting principles class was a while ago, so you're having a hard time remembering, right? Just jot that down. That'll help you a lot. I covered that just a little bit in cost management. A lot of you have already had cost management. We talked about that just a little bit early in that class, but you might not remember it. Okay, everybody okay with that then? So I'm going to just write down a little formula here, and that'll help you too. So my formula is this. So I'm going to say RE, so, and then BOY for beginning of year. So retained earnings beginning of the year, okay, plus net income minus dividends equals, excuse me, retained earnings, and then EOY, which is end of year. Okay, so there's your formula right there. If you have that formula down, that'll help you a lot. So just jot that down. And I meant to make this be a capital E right here. I think it changed it on me without me realizing it. And same here. Okay. So retained earnings beginning of year plus net income minus dividends equals retained earnings at the end of the year. Okay. So pretty easy to see here. My beginning retained earnings was $855. Okay. We had net income. I'm just going to plug this number in right here of 70 million. And then my ending retained earnings, they told us was 900 million. Okay. So I know my beginning number is 855. I know my net income was 70. I know my ending is 900. So the solve for is dividends, right? The one piece they did not give us is dividends, but I can figure that out. And so the dividends is basically this number here, 855 plus 70 minus the 900 million retained earnings. Let's type that number in easier. And I should get 25 million. Okay, so the sum of these three together, and this should be a minus, so that, just think of that as a minus. So 855 plus 70 minus 25 equals 900. Okay, but that's a pattern you kind of just have to know, and a few problems will deal with that. Okay, then question 7. It asks for Zucker Inc. It says reported 4 million net earnings before interest and taxes, and a federal tax rate plus state tax of 25. What is the free cash flow? And so this is called net operating profit after tax, NOPAT. You'll see that term a little bit in the chapter. And so I'm doing the formula for you here. And so your NOPAT, net operating profit after tax, that equals your EBIT times 1 minus T. Okay, so that's the formula for it right there. So they gave us the 4 million of NOPAT, and that equals my EBIT times 1 minus T. So I don't know the EBIT, but I do know my 1 minus T, right? So I just multiply that by 1 minus 0.25. Okay, so basically I'm just taking 4 million times 0.75, and we get 3 million. So basically the answer is free cash flow is 3 million. Okay. So the key is after-tax cash flow, right? After-tax cash flow is 3 million. That's the net cash the company can keep and do something with. Okay, the next one is question 8, and I think that's the last one I'm actually going to do. I copied in here more than I meant to. So question 8, let me get the whole thing on the screen here. It says that Gen Translation reported 10 million of current assets, 15 million of fixed assets, 3 million in net operating current liabilities. How much net operating capital does JT have? Net operating capital. Okay, so I'm going to give you a formula again. There's a formula for everything, right? I think you probably will discover that in finance. And I'm not making you really memorize any formulas. The way the homework is all set up, everything's open book, open note. You're kind of just doing it on your own. So don't worry about memorizing formulas. It's more about, can I find the formula so I can use it at the right time? But it's good to understand kind of what they mean and what they're trying to tell us. So total net operating capital, I'm just going to abbreviate that a little bit. So total net operating capital, that equals net fixed assets plus net operating working capital. Okay, that's the formula. So total net operating capital equals net fixed assets plus net operating working capital. Now, net operating working capital, this portion right here has a little sub-formula within it. So that formula is this. It's plus your operating current assets, CA, minus your operating CL, current liabilities. So your net operating working capital is your operating current assets minus your operating current liabilities. Okay. So what's that word operating mean? It's the assets and liabilities that you have or incur as you go about your day-to-day operations. Okay. So net operating current assets would be quite often things like receivables, inventory, prepaids, cash. Operating current liabilities are typically accounts payable and accrued liabilities. Okay, so but they will tell you, they're not going to leave that be a mystery to you. They'll tell you what those numbers are. So let's go ahead and plug the numbers in. So my net fixed assets is 15. Okay, and then they said that we have 10 million current assets and 3 million of current liabilities. So I'm just going to go 10 million minus 3 million. So then I just sum the two numbers up and I get 22 million. So the sum of the two is my total net operating capital is the $22 million. Okay. So why does that matter? Why is that important? Well, that's the capital that the company has as it goes about doing its day-to-day operations. So fixed assets, property, plant, and equipment, net operating working capital, your current operating assets minus your current operating liabilities. Okay. So I just want to mention that again, what current operating assets are. Inventory, cash, receivables, those are the big ones, and prepaids. I should mention prepaids. And then your net operating current liabilities are your accounts payable and your accrued liabilities. Okay, so sorry for the clunkiness of this. I'll have this figured out for next time. So WebEx changed on me, and WebEx is not allowing me to record anything, so my bad on those. But I did a screen recording using Screencast-O-Matic, and so I'll save this and publish this and upload it to YouTube. So there will be a YouTube recording that you can look at for this. Any questions from anybody? I'm really sorry if it was kind of clunky.
Professor,
yeah.
Can you go over number 2 again? I got really confused.
Oh,
when
sure.
You started changing what you were doing.
Yep. Yep.
I couldn't follow the.
You know what?
Doing over on the right.
If you guys don't mind,
I'm so sorry.
yeah. Do you guys don't mind? If you guys don't mind, I think what I'm going to do is do a separate recording for this one. Is that okay? And I've got a sore throat, and it's kind of giving out on me right now. If it's okay, are you guys okay with that? And maybe I'll just kind of draw something up on using a bit better format that'll show this. Because I didn't show this very well, I'll admit that. But I can do it better, but my voice is kind of needs to rest a little bit. Is that okay with everybody? So, how about, I promise I'll follow up. Is that okay?
That's fine.
Okay.
Thank you.
All right. Yep, I will do that, I promise. What I'll do is I'll kind of send out a little email tomorrow with the link to this recording and just a little bit better explanation for question 2. Okay?
Thank you.
Okay, you're welcome. Thanks for asking. I'm glad you did. Thank you. Any other questions from anybody? I started getting sick yesterday, and I'm kind of just hanging in there right now. Okay. Please feel free to email me if you've got questions. I'm always okay with you calling me or texting me too. And my cell phone number, it's on the syllabus, but it's 605-321-0092. So it's always okay to text, call, email. I worked really hard to get back to you within 1 day. Okay, so I owe everybody a link to this recording and a better explanation for question 2. And I will follow up with that tomorrow. Okay. All right. Thanks everybody for being here. I really appreciate that. And if you need anything, just let me know. Thank you.
Thank you. Thank you.